Rick?
Yes.
Okay, we're live.
Okay, Happy New Year, everyone. Welcome to the Council of Revenues first forecast of 2026 for the general fund. And we're calling the meeting to order. The first item is, has there been any communications with the council?
No.
Okay.
And then if the public would want to comment, please do so, indicate in the chat box.
Yeah.
And you will also have an opportunity to speak if you want, but just let us know.
Okay. So if you could either raise your hand or send a message if you want to, if anyone from the public would like to comment. There is nothing in the chat. Nothing in the chat. I don't see any hands raised. So, okay, we have received, council has received no comments or communications. Okay, next item on the agenda is the minutes of the personal income forecast meeting on October 30th, 2025. Any discussion? Anyone want to discuss any points? Okay. Any motion to adopt the minutes?
I move to approve.
I'll
Any
second.
second? Okay,
I'll second.
Okay. Okay, we're going to take a vote on the approval of the minutes from the council's meeting from October 30th, 2025 on personal income. Vice Chair Maynard?
Aye.
Dr. Bonham?
Aye.
Okay. Councilmember Hayashi?
Aye.
Councilmember Astaga Clem?
Aye.
Councilmember Hamasu?
Aye.
Councilmember Bennett?
I abstain, I was absent.
Okay. Okay, so the minutes is approved by the council 6-0 and with one abstention. Okay, the next item on the agenda is the review of revenues by the Department of Tax. Baybars, would you like to kind of take us through the presentation?
Thank you. I'd be happy to. So yeah, as I mentioned, I am now officially the Tax Research and Planning Officer. So I welcome you, and I'll be happy to keep working with you. As you know, I've been in the office for 7 years prior to this, and have been assisting with the TPI, Council on Revenues TPI meetings, but I'm taking over the general fund aspect as well. So bear with me. I'll be working more closely in the models and the forecast, assisting the council in their forecast. So my presentation is basically providing a little bit of background, sharing what's going on in the fiscal year 2026 so far, and putting it in perspective of what we observed in the previous fiscal year. So as you may remember, in the biggest tax collections, GET collections, they were up by 3.3% in fiscal year 2025. And when we moved to fiscal year 26, for the first 5 months up to November 2025, compared to the same period in the previous year, the GET collections were up by 7.2%. On the other hand, the second most important component of the tax collections, individual income tax collections, they were flat mostly in fiscal year 2025. And if you can see the highlighted section starting in January 2025, when the new withholding tables went into effect, what we see is that we start to see a negative a decline in individual income tax collections. This does take into account the increased standard deductions and the expansion in the tax brackets. And this was the revenue estimates that were provided for last year's meeting, which is still in effect this year because the Act 46, the tax cut bill, is being rolled out gradually over the years. So as of January 2026, we have the new standard deductions, which are almost quadrupled from their original levels back in 23. And this benefits mostly the lower and middle income taxpayers who tend to rely more on standard deductions rather than itemized deductions. And then also effective for calendar year 25, which got reflected in the withholding taxes, is the expansion of the tax brackets, which means, as I'll show one example in the next slide, I picked a sample of joint filers and compared it to the previous tax schedule and compared it to the current tax schedule that is effective this year. Is if for a low income earner between, let's say, making 25,000 as a couple, their marginal tax rate was 6.4%. It would go down to 3.2%. But this affects everybody. So even someone making upper middle income, moderately high income, somewhere between $400,000 and $600,000, they would be subject to 11% marginal rate previously, and now they are in lower tax brackets. So this is kind of the expansion, but on the lower right-hand side of this slide, you can see some statistics. This is the tax liability reduction as a share of the actual tax liability these taxpayers had before before this bill went into force, and you can see the progressive nature of the way that the taxes do roll out, and it's disproportionate to the income level. Overall, though, coming back to the actual collections this year, what's happening is we're down by 15.5% for the first 5 months of fiscal year 2026. And this is exactly in line with the 600 million reduction that the TRP office had forecast or estimated as the impact of the bill for fiscal year 2026. And this is to add to that, we talked about 2 additional pieces of legislation that went into effect in 2025. The first one was the pass-through entity tax add-back. So under the new act, when somebody is claiming a PT pass-through entity level tax credit, they would now add it back to the taxable income to eliminate the benefit of taking the tax credit plus having a reduced taxable income. So that is about 30 to 40 million impact in individual income taxes. And the next big one is the increase in TAT, the so-called climate impact fee or the green fee. There's an increase by 0.75% in the transit accommodations tax, and a new imposition of TAT on cruise ships. And the combined effect of this was about 120 million.
Davis, I have a quick question on the cruise ship. Isn't that in litigation in federal court right now? Isn't it being challenged by the cruise industry?
Yes.
What is the status?
I will. Yeah. So what happened is we just have an announcement as of this month. So we are there was an appeal to the 9th Circuit Court, and it basically is the state is legally barred from applying the TAT on cruise ships until further notice. So the department will refrain from enforcing the act as it relates and applies to cruise ships at this point. So towards the end of my presentation, I will provide you with some revenue estimates if we take out the impact of this bill as it applies to cruise ships, which is about 20 million of this of this about $80 million.
the-
That is
The ruling was at the trial level, the U.S. District Court level, and it's being appealed to the Ninth Circuit.
right. So it has been so the Ninth Circuit Court did order the state to so we're basically enjoined on this. But what will happen? What's going to be the outcome? We don't know. The position of DOTAX is that we'll refrain from enforcing it until further notice, according to this ruling.
Yeah, Kurt. So
But it's not like a permanent injunction, right? It's like
No.
Yeah,
preliminary.
the Ninth Circuit hasn't ruled on the actual appeal yet, so that's why
On the merits.
it's just a stay on the tax right
Collection.
now.
Yes.
Yeah.
Yes.
Okay.
So
if-
yeah,
if
we
this-
have no position as to what might be the outcome. So it's not
Okay.
currently the council's forecasts were based on the revenue estimate that we provided for full Act 96 taking effect.
Okay.
But just coming back to the collections, TAT collections were slightly down in fiscal 2025, and this was partly due to the negative impact of the Maui wildfires. As you can see, the liability of TAT coming from Maui went down by about 22% for the last 2 fiscal years. And if you actually look at this chart, the composition of the TAT liability of Maui County shrunk by about 7 percentage points in the last 2 fiscal years. So this is definitely bearing down on the impact. And overall, though, in fiscal year 2026, for the first 5 months, the TAT collections are slightly up about 1.8% compared to the same period previous year. And otherwise, it's mostly flat. For the corporate income taxes, again, this is a volatile portion. This is the 4th largest tax item for the state. And they were down by 17% in fiscal year 2025. And part of this, I think, does reflect the fact that the PTE tax rate, the pass-through entity tax rate, was reduced from 11% to 9% in tax year 2024. So part of it will reflect that. So although the pass-through entity taxes are supposed to be revenue neutral, it creates this previously non-existent tax at the entity level for S corporations and partnerships. So to give you a sense of the magnitude, that's about 185 million in tax year 2023. So with that rate being reduced, that will then go into individual income tax returns. That might be playing into this. But having said that, this year it's down by about 16.4%, and if you look at the national trends, the median U.S. state saw about 20% decline in corporate income taxes in the current fiscal year. So we are observing the same trend across the nation, and it's being attributed to the post-pandemic slowdown in revenue growth after having seen some record highs. But what we observe in Hawaii is not different from what is observed across all the states in the nation. Coming to the general fund. So in fiscal year 2025, we did end up at 4.2%. But as I highlighted, the September 2024, we had this one-time boost to the estate tax collections of 315 million. So that is the main reason for this 4.2% rise. Otherwise, it would have been mostly flat. Having said that, when we look at the first 5 years of the fiscal year 26, we're currently down 10.5%. So to not muddy the waters, but if we were to remove the effect of this one-time increase in estate taxes, we would be looking at a negative 3.2% decline in the general fund. And this is for the first 5 months of fiscal 26. So if for the remaining 7 months, even if the rates were 0% each month, we would end the year with about negative 4.6% general fund growth. This is completely in line with the council's current forecast, the latest forecast from the previous meeting in September. So currently, the course forecast stands at negative 4.7% for fiscal year 2026. And as you know, the predictions for out years already accounts for all the major tax-related measures passed in 24 and 25. So this is the below the line numbers. So it hovers around 2% for the next 4 fiscal years after 26, and then around 3% for the 2031 and 2032. Now, here is the current. So based on the mean forecast of economic indicators that the council provides to us, and based on the historical regressions that we run on the data, the forecast, the model forecast is below the previous official core forecast for every year, including fiscal 26. So it's about negative 5.4% in fiscal 26, and it's about a percentage point down for the other years. Coming back to your question, Kurt, so I have separated out the impact of the cruise ships aspect of Act 96. As I said, it's about $20 million. So previously non-existent TAT imposed on cruise ships. If we were to take out the effect of that, then these numbers would be slightly adjusted. Again, I'm not saying I'm not making any prediction about the outcome of the lawsuit, as you indicated. It's in appeals. The effect is about 10 basis points for fiscal year 26 and fiscal year 2027. This is when I take out the cruise ship aspect of the TAT from Act 96.
It's 0.10 versus 0.2.
So it's a negative 5.5 as opposed to negative 5.4, and for fiscal year 26, and it's 1.1% as opposed to 1.2% in fiscal 2027. All the other out years don't see any effect. The effect is negligible.
It's 20 million, right? The impact per year.
20 million, correct.
And
Yes.
isn't general fund about 100 million a point?
You mean billion, 10 billion?
Yeah.
Yeah.
Yes. So the impact is negligible in the grand scheme of things, but it does. Just wanted to give you some idea about the magnitudes we're talking about, in case you do consider taking this into account. We're not, again, making any predictions, but it seems like the council's economic indicator forecast is slightly more pessimistic this time around, and that is reflected in the input mean forecast. But that is all I have, and I'm happy to answer any questions. Are there any questions?
You know,
Yes.
the withholding, what is the maximum rate that the state requires employers to withhold? Is it 7% or 8%?
That is correct.
Okay.
So the withholding rate doesn't go all the way up to the actual marginal tax rate.
11% rate, right, for individuals.
That's correct. Yes, but we did. It does take into account the new income brackets, which is expanded.
But not completely. So in other words,
It doesn't go all the way up to 11%. No.
So if you took on a household with $150,000 of income or $100,000 of income, and it's all labor income, and you adjusted their withholding automatically, are they going to get a bigger refund this year than say normal, because the withholding adjustment wasn't complete?
I did do some some simulations. That's why I hesitated. I actually had to come up with the new withholding table. So if there's any errors, blame me. I
mean, you
think you're
don't.
right. I think you're
So
right. So there
you
might
don't
be a little
adjust the
bigger refund.
withholding. You don't adjust the withholding to like 100% of what it would be, because you might accidentally under withhold, and then they'd have a big tax bill, and you don't want people to get angry. So
Right.
presumably
That's the goal.
refunds will be a little bit larger this year.
I do. It is fair to expect that. That is my that is my expectation.
Because the tax package kind of stretched out the brackets, right? And it increased things like the standard deduction. So that seems to be going more in favor of the tax.
Well, in last fiscal year, it was just the brackets, right? It was the previous, I think I got that right. The previous fiscal year was the standard deduction, and then last fiscal year was the brackets, and then this fiscal year, it's the standard deduction again. So,
But they're
and
all
I
in
don't,
favor
and they
of the
didn't
tax
adjust
bill.
anything for the standard deduction.
So all of those changes are in favor of the taxpayer.
Yeah.
But so on a net overall basis, it reduces the tax to the taxpayer. But,
Correct. So
Which,
one
as we're
quick note,
seeing
though,
in the withholding.
yeah.
Right, Carl. One quick note though. We did update the withholding tables one more time this year,
Oh, okay.
26.
Okay.
Which way did it go?
in taking into account the increased standard deduction happening.
Oh,
So
okay.
so
Good.
the impact kicks in earlier. So instead of waiting all the way until fiscal year
Right.
27, it kicks in earlier.
So they might see the
So
benefit.
if I go and look at my paycheck, it probably shows a little bit less in state income tax taken out of my paycheck for the same income level.
Exactly.
Even though I don't use the standard deduction.
Correct.
Okay.
Yes.
Hey, Bryce, I have a question. So you made the comment that if there was 0% growth in the general fund for the rest of the fiscal year, we'd end up at 4.6%. But looking at it, just curious, the major drivers are obviously GET and then the income taxes. Do those offset each other? Because I know income tax revenues were down, GET was up. Overall, as a dollar percentage, do they dollar amounts, do they basically offset each other such that, it's reasonable to expect a 0% growth, or is these tax cuts going to create something where it's likely it may be negative?
It is negative. So that's why, like, currently, partly because of the days being higher to in fiscal 2025. Go ahead, Carl. Sorry.
I was just going to say, GET is up 7%. Individual income tax is down 15%. So and the total, including, so if you took out the estate tax, then the general fund is down 3.2%. Right. So that's the negative. You put it, in other words, the excise tax increase doesn't offset, and the TAT increase doesn't offset the income tax reduction, because when you net out that estate tax change, we're still down 3%. I think I have that right.
Yes.
Yeah, and I'm just looking at the preliminary comparative statement where on the GE taxes, we're down 134 million, while on the income tax, we're up. The income tax, we're down 217. So that.
But that has the estate.
Yeah.
That has the estate tax in it, right?
No, without the estate.
Okay.
Tax.
Just okay.
Yeah.
Where do you put the estate tax on the preliminary revenue?
It's in other taxes.
All others.
So
All
it's
others.
okay.
Yeah, that's.
But the pass-through entity tax, you put it in the income tax category.
In the corporate income tax.
For the corporate.
Yes, correct.
Even though technically it's not corporation, but that's where you put it.
It is. Yeah, we consolidate all the partnerships and S corporations and C corporations in terms of the reporting. Yeah. Correct.
So basically what we're dealing with is a kind of artificially high base because of the huge estate tax payments in fiscal 25.
among
And-
other things.
among other things.
Yeah, so we have to deal with not only that, but also the net of the GE and income tax is actually negative year over year. So it's not keeping up, yeah.
May I stop sharing the screen, or if you want to move on to the, or
Yes,
are there
yes,
questions? Okay,
yeah.
thank you.
Hey,
Do you have
Bybars,
some-
sorry.
Yes,
There's a
please.
question in the Q&A.
Oh.
Do you guys want to take a question?
Okay,
Yeah,
I'm not sure if you guys see that, but
okay, let me see.
I can't see a question in the chat.
Oh,
Is it somewhere
okay.
else?
How much or little
Oh,
does
who can
the
see a
Council on
message?
Revenues adjust financial collections?
We don't adjust them at all.
Not at all. No.
I'm not sure what financial collections is.
Yeah,
I
I'm
assume
not sure
that's
what
just
that is.
tax revenue, but yeah, the council doesn't adjust anything except our forecasts.
Correct.
Would it
Okay.
be helpful to look at the comparative statement?
Yes.
I've
Yeah.
got
I think
that
it
up.
would be.
Let me share that. Sure, I'm sharing the right screen. Can you see that?
Yes.
Yeah.
So at the very top, you can see GE taxes are up 7.3%.
Yeah.
That's at 133.9. But income tax for corporations are down 21. Individual income taxes are down 217. So the net of all of that, even with the TAT tax, we're still down before we even look at the 342. So it's
So
So
what
this
I
is
was
the-
saying was that if we take this, if you look at previous month, it was negative 14.6%, because that's October, and then September it was. So it's every
Declining.
month it's going to keep declining. By the end of the fiscal year, we might end up somewhere between -4% and -5%.
Hey, boys, do we know what the end of December looks like at this point?
We will know this Friday. Yeah,
no hints at all.
no
Because I
hints
know
yet.
you have to get information from some other departments as well. Come up
Yeah,
with a
we do,
final.
but like the preliminary, that's why it's preliminary. This does miss some of that information. So the final numbers usually have a 2-month lag at least. But what I shared with you is the major tax collections, and those do not change. So the GET, the individual income tax, the TAT. So those numbers are what to rely on for the most part. And those we don't have the December numbers
Okay.
yet.
So the numbers you've given us is as end of November.
November,
We don't know what
correct.
December looks like at this point.
We don't know yet.
Mm. Okay. Any questions of Baybars on his presentation? Okay, we'll move on to the next item on the agenda, which is the forecast for the current fiscal year. Anyone want to start us off? I normally go to Dr. Bottom, but I want to see if invite anyone else to start us off.
I'd love to hear what Carl has to say.
Okay.
I like
Dr.
our old
Bottom?
forecast.
Huh?
I'll start with saying I like our old forecast. I don't like the new one. I don't understand where it's coming from. I mean, looking at the council inputs, they aren't that dramatically different than last meeting. I think the biggest difference might be, I mean, the real GDP growth is a little bit, tiny bit lower. Wages, for some reason, the council mean forecast for wages is quite a bit lower and doesn't make a lot of sense to me. But I don't really think that matters that much in the forecast model for general fund. So it may be that just a 1/10 or 0.2% lower real GDP forecast for the council mean forecast is what's driving this. And I mean, I would say that it looks to me like that real GDP. This is on page 5 of the core workbook, right? It shows Hawaii real GDP, and this is real in constant dollars, pretty much at 1%, 1.1% in the out years. And that's a little bit on the low side. I mean, that would be pretty anemic growth. So to put that in perspective, some of the slowest periods of growth in Hawaii history have been 1.2, 1.3%. And so those numbers went down. That may be what's pulling it probably has a pretty big weight in the model. That's probably what's pulling the forecast down. And I'm not sure I believe that. I mean, I know I tend to be pessimistic, but for the overall outlook, the last time we met, we were still living with a big data hole. Actually, that wasn't the last time. And when we released our last forecast, we were still dealing with a pretty big data hole. And some of that got closed up this morning when we got the jobs data. And some of this not surprises in the jobs data were a 2,000 person loss of federal civilian workers in October, which was the result of the early retirement package that DOGE put together. And yet overall jobs still went up over 1,000 people, and construction jobs are still at record levels. So I guess I would characterize the incoming data as a little bit more positive than we expected. So I took the incoming tourism data, which honestly I'm having a hard time understanding what the heck's going on.
Yeah.
Because you've got basically flat to down for all the numbers related to people, right? I mean, essentially, we're likely to end the year with basically no growth in the number of visitors and maybe even a slight decline in the average daily census. And yet, particularly over the last 3 months, the visitor spending numbers have jumped through the roof. That's too strong, but they've jumped pretty significantly. And at the same time, you've got no growth in hotel room rates, and occupancy rates are flat. If anything, I think the average daily rates for the state's probably down 1% or 2%. And so the visitor spending, in order for that to make sense, and actually if you look at the per person per day spending, it's transportation, entertainment, and eating out. And so then if you go and you look at prices for those categories, right, we have CPI data on food away from home, and those are roughly the same prices that visitors would pay, and those prices are up maybe 4.5% for the year. And we're seeing supposedly visitors increasing their spending on eating out by 15 to 20%. So I don't really know what's going on, but the numbers are pretty strong. And the visitor arrivals numbers came in a little bit stronger than we had forecast. So I adjusted our forecast and reran the tax model, and it boosted our internal general fund forecast by about 30 basis points, just from the increase in visitor spending and the increase in arrivals. And the forecast that comes out of my model for the general fund is a little bit more upbeat than the council. So I think it was minus 4.4 was what I had before I did the adjustments to tourism. And then I get like minus 4.1. So basically I like the old forecast. I guess I should also say that obviously the data for the U.S. economy has come in stronger than most people anticipated. I wouldn't pay any attention to the CPI data that came out because it's mumbo jumbo, and unfortunately it will never get fixed, and it'll take us almost a year to catch up because of the way things are calculated. And so I don't think it's a reason that the Fed's going to suddenly start cutting rates. But obviously the third quarter GDP number was a pretty substantial surprise to the upside. So our forecast for U.S. GDP that we're working with for our next forecast is something like 30 basis points higher, for maybe 40 basis points higher for 2025. And almost 2% for 2026. So those are pretty, for our forecast, those are pretty big changes. I still think there's a lot of risk to the U.S. economy. I guess I would describe it as being kind of fragile, just because the growth is so concentrated in essentially high-end consumption and AI investment, and if those are highly related, right? I mean, if the AI is really driving not only the investment in physical plant, but also the stock market gains, which are then contributing significantly to the high-end consumption. So any disruption in that is kind of scary. Let's see.
You had, Carl, you had talked about a possible small recession in Hawaii in 2026.
I'm guessing when we revise our forecast, I'm guessing that won't be in the forecast anymore. It was a really, we were talking about like a 30, 40 basis points increase in the unemployment rate. Basically, small decline in jobs. And I don't think we may have already been through a mild recession in Hawaii. When we get the revisions to the jobs data, it wouldn't surprise me if we see that. But it's really tough to say, because the tourism numbers are, I'd say, a little bit better than what we expected. Is that going to continue? If the U.S. economy grows at 2% next year and stock market grows at, let's say, anywhere between 5 and 15, I suspect that the tourism numbers will continue to improve. So I'm a little bit more optimistic than I was last time, for sure.
Mm-hmm.
Yeah,
Carl.
I'll chime in to say that my experience in reading forecast reports and estimates and revisions that have come in, particularly the last 3 or 4 weeks, there's been a lot more good news than there's been bad news, which has fed confidence. And that can be a self-fulfilling prophecy too. Is when confidence gets strong, people tend to be a little bit more bullish about investment decisions and consumption decisions. So to me, it's a very different temperament that's happening right now than what we were experiencing 6 months ago.
Yeah, and there's going to be some pile on there. Although the last Michigan consumer confidence data was pretty lousy. The consumer's assessment of current conditions was shockingly bad, which I really think, I think it was an all-time record low, and I think what that's reflecting is just that for everybody who's middle income and below, that's the way it feels. That's their reality, right? But one of the things that's going to happen in 2026 is that they're going to get bigger tax refunds than they have in the past, right? Because of the tax law changes. And of course, there's going to be complete deductibility of investment. There's a lot of tailwinds coming from tax law in 2026.
You're talking about the federal tax law, right?
Yeah. Yes, absolutely. Yeah.
Okay.
So Carl, do you think that what you just mentioned about how the consumer sentiment for those middle class and below are feeling the impacts, but those at the higher levels may not be? Hawaii always has been kind of a luxury destination. So could that explain why the spending might be up, because they're willing to spend more?
Well, that was the very first, there's basically the first 3 things that we tried to explore to explain it was, one, is it a mix issue because of return visitors to Maui, right? Which is a high dollar, high cost destination. That's a piece of it, but it by no means explains the size of the changes we've seen. And number 2 would be, are we just attracting more high spending visitors, or is it Japanese? Well, the Japanese are not high spending visitors anymore in dollars, right? The US visitor spends more in dollars than the Japanese does. So that didn't help. And actually, as a share of total visitors, the Japanese hasn't changed that much, even though they have seen some growth. And then for the high spending, so that's possible, but I would have expected that in order for that to be driving this, you've got to have essentially, remember, visitor numbers are flat. So just imagine that there's the same number of visitors, but you've got a larger proportion of them are very high-end, high spenders. Well, then why wouldn't the average daily rate go up? I mean, they're not staying in off-beach hotels in Waikiki, right? If you're maybe they are. Maybe they're staying off-beach and spending all their money to rent, high-end cars. I don't know what it doesn't make it.
Could the
It's hard to make sense of the data. It's hard to make sense.
The data is also more volatile than it is historically. So if you look at the pattern of arrivals across the islands and over the course of the year, there's been more volatility in the visitor data, I think, than you would find pretty much any time other than an outright recession. So I don't know what's going on, but it's not fun.
Carl, that does. Oh, sorry, Scott. Go ahead.
Oh, well, I was just curious with regard to the, I guess, the daily rates for hotels. Does that include like Airbnbs? So would the crackdown on
Airbnb? We actually Airbnb rates have fallen, and what we do is we do a weighted average of the average daily rate for short-term vacation rentals and the average daily rate for hotels, and that's the number that I'm talking about. So I'm pretty sure that the short-term vacation rental prices have fallen more than the hotel prices. And I don't know if that's I don't know if, probably the highest end visitors are staying in Taupuna and not in a short-term vacation rental, but I don't know that for a fact.
That was one of my questions, Scott, too. But also, have any of the data collection methods changed?
There's a lot going on there. But not, the intercept surveys really haven't changed, but I'm not sure that they have as good of idea of where people are, right? Because if we weren't getting in-flight surveys, it's not clear that they have as good of idea of which island they're going to, and we've seen pretty big declines in visitor numbers to Oahu, and I don't know if that shouldn't drive changes in spending, but however they recalculate to get the total spending may be impacted by the lack of that survey. But the good news, it's coming back, even though I didn't fill one out on my last flight. They didn't say a word about it.
They didn't offer you a pen.
Well, it's online now, right?
Yeah, I know.
They didn't offer me anything.
That's why you don't have to worry about pens anymore.
Yes, that's nice.
The last flight I was on coming in, they made us wait at the gate because they didn't have enough responses.
Yeah, I heard about some of the airlines being pretty aggressive, saying you can't get off the plane until we've got them all filled out.
Do they sync
so
it? Do they sync it with the passenger list?
That would be a little surprising, but they may just be counting that they have a high enough response rate.
Because it's only one per family too, right?
Look, on the flight I was on, there was no mention of ag, visitor, anything. None at all. Oh, we've got another question. Oh, thank you. Rika said thank you for the.
Oh, okay. So, Carl, what is your number? You would leave it the same? That's her recommendation?
Yeah, I'm not sure I would change it at all.
Yeah.
If I was going to change, I might change this year up a little bit, but we're talking, really small numbers. And obviously there's a lot going on for this year.
Yeah, with all the new changes in the tax withholdings and tax rates, a lot of uncertainty, of course, always, but it seems like we have an additional layer here.
Carl, could I ask? We haven't talked anything about construction, so you're still pretty on target with those.
Yeah, I was going to look at what
I know in December you were saying it
was for
kind of an all-time high. I looked at your December number, and you seem pretty confident that would still continue to to hold?
Yeah, I'm comparing my survey from, oops, wrong form. Let's see. Survey from September 4, right? There it is. No, I can't find it. I was trying to, was September 4 a general fund meeting or a TPI meeting?
General fund would,
Yeah,
in September.
for some reason I can't find my results from that. I think I accidentally overwrote them. I mean, I continue to have growth in the contracting tax base in the 3 to 4% range for the next several years. This fiscal year is not quite that strong, so I think that probably explains why the council's model using my inputs was as weak as it was. Let's see, the council mean for construction is 4% and 4.4% this year. Mine is more like 2%, but the out years all look about the same. And I think that is reflecting that in our forecast. I mean, construction essentially ramped up at the tail end of last fiscal year, and then the growth is much slower going forward. But it's all of my construction tax base forecasts are positive going out.
And it's at a very high level. Yeah.
Yeah, I mean, it would be hard to post growth rates over a couple of percent going forward. Yeah. Although there's a lot going on, right? I mean, there was an announcement the other day that Hawaiian was going to revamp its terminal, and a lot of that spending would be on airplanes and things that aren't really construction. But I can't remember. There was something else that was recently announced that was pretty. I can't remember what it was.
Yeah, Carl, your forecast is consistent with what we're seeing. I mean, there's still a lot of large projects that are being pushed out, both by the state as well as city and counties. So, and with the stadium, now greenlit.
Did they start the demolition already?
I believe so. That was my understanding.
I thought they were going to start it in December, but I wasn't sure. I forgot to get my seat.
Yeah, so that's why there's still a lot of projects. I mean, even Hart is looking. I mean, they I think authorized funds to start designing to Ala Moana. So even though it hasn't been approved yet, so there's some funding there, and so
that's a 2035 project
for the actual construction. Absolutely, yeah. But it seems like there's dollars still flowing in that we're seeing too.
And I think the market is probably pricing in a couple more Fed rate cuts in this year. I would say we would probably come down between 2 and 3 cuts, and if it's 3, that's probably means things aren't that great, because let's cut because jobs are dying. I mean, we'll know a lot more on Friday. I'm a little worried about the next jobs report, but yeah. So the rate environment could be a positive there.
Yeah, we've been seeing the futures market is anticipating 2 cuts for the remaining for this year, maybe 3. Probably not until second quarter, but
yeah,
it's been interesting. I mean, from my standpoint, to see how tight the range has been on the 10-year, which is where mortgage projects are priced. So I'm looking at it right now. It's at a 4.15. It's been kind of between 4.10 and 4.20. It seems for a long time.
Yeah.
Yeah, no matter
Yeah, and
what
the last cut, it actually went up a little bit, went up to like 420. Yeah. I mean, our view is that the long rate is the 10 years about where it should be.
Yeah.
And there's no particular reason for it to come down much.
Yeah, I mean, if we're going to have a normal yield curve,
Right.
the short end has to come down more than the long end. So
Yeah.
we're getting closer. We're getting closer. Just a little dip right now in the short end. Nothing like it was 2 or 3 years ago. Oh my goodness. Well, I feel comfortable with Carl's idea of leaving our forecast where it is. My only worry is that difference between the, we're not really catching up with GE taxes being up, but income taxes being down. And of course, we'll know a lot more when April numbers start coming in, because that's when we have the big numbers for the income tax. But I'm comfortable leaving it where it is.
In B-bars, with regard to the corporate income tax, you mentioned that the TET is in there. So basically the TET, or is that separate?
That's
from,
separate.
okay.
Separate.
So, but the
Yeah,
cruise
correct.
ship impact is going to be about 20 million, at least for the projected hold. Is that what it is?
Correct. Just to add to your point, and Carl, like comparing the forecast of key economic indicators and the big drivers, like the council's visitor arrivals was 0.92% in September, and now it's negative 1.4%. And this goes into every regression equation that we have pretty much.
Yeah.
So that kind of explains. And then the TPI is also about 2% less than what was forecast in September. So this completely reflects the average economic forecast of the council.
Yeah, I don't know how I missed that 1.4%. So when I revised based on the data for October, November for tourism, when I tweaked our visitor forecast, it went up to only -1% for the fiscal year. That's our internal forecast for fiscal year visitor arrivals
For the year.
for the fiscal 26. Yeah.
And Kurt, there's the attendees are asking whether the council can reiterate the updated forecast percentage, and if you want to answer that.
I'm sorry, what was the question?
They're asking if the council can reiterate what the updated forecast percentage is, and I don't
After
think
we
that has been
decide.
much after
Yeah.
we decide. Yes.
Yeah.
Sure.
So any further discussion? So, Carl, you have a motion?
I can, or I can let
Yes.
Christy
I think Christy
take
was going to second it,
responsibility.
though, either way.
Yeah, I move that we leave the forecast unchanged.
I'll second.
And that's at 4.7% for the current fiscal year, right?
So negative 4.7.
Negative 4.7%
Yeah,
for the current fiscal year.
Mhm.
Okay. Okay. Any further discussion? None? Okay. So we're going to take a vote for the current fiscal year 2026.
Wait, did we get a second? I think Christy, did you second that?
Yes, I did.
Okay, sorry.
Okay. So the motion on the table is that to leave the current forecast as is for the fiscal year ending 2026 at negative 4.7%. Okay. Vice Chair Maynard?
Aye.
Dr. Bonham?
Aye.
Councilmember Hayashi?
Aye.
Councilmember Asagat Klam?
Aye.
Councilmember Hamasu?
Aye.
Councilmember Bennett?
Aye.
Okay, so the vote carries unanimously, 7-0. Okay, so the next item on the agenda is the discussion and vote on the next fiscal year 2027. Anyone want to lead us off?
I move that we leave the out years unchanged.
All of the out years, you saying?
Yeah, that's what I meant when I said I like the
Okay.
current forecast.
Anyone want to have discussion?
Well, I wanted to reiterate what Marjorie and Scott mentioned. I think what we're seeing is a definite change in the perception that the economy is improving. We just completed our year-end figures for commercial real estate, and investment sales have dramatically increased at year-end. We've got improvements in vacancy across the board. So from a business perspective, it seems that overall, the perception based on the data that we collected that there's an improvement overall in the economy from a business perspective. So, if we keep the forecast similar to where we are now, I propose maybe maybe a slight steady improvement on top of the numbers that we currently have. I mean, I know it's marginal at 1% or 2%, so might be a fraction of 1% going forward. But I just thought I'd raise that as maybe a little more optimism going forward.
That's so unlike you, Mike. But
I know. That's
well,
based on thinking that Carl was going to say, "Oh, we're going to have a recession next year too, or this year."
so the out years are 2%, a positive 2% for the next fiscal year, and then 1.9, 2.5, 1.8, 3.1, and 3.4. So there is a steady, well, not steady, there is an improvement going forward.
So yeah, you have to remember that part of the reason those numbers are as low as they are, we really need to see the above the line numbers because those are being pulled down by the tax law.
Yeah.
So for example, if you look at table 5B on page 9, it shows the above the line, and this is the current model-based forecast. Basically, everything's at 2.5% for the next 3-4 years, and where it's the below the line is a full percentage point below that. In some cases, 2% below that. And yeah, I have last September's book open right here. So the above the line was except we didn't adopt that forecast. Never mind. We modified it. So I don't disagree with you, Mike. Just pointing that out. So it's kind of hard to look at those numbers and disentangle the economics from the tax law changes.
I have a question relating to, didn't the governor put on the table the possibility of revising the tax strategy going forward?
Yeah, but it's not law. I mean, we're stuck with what we have.
Yeah, we have to, we can't, or we're not supposed to take into account things that may happen with the tax, with changes in law.
Papers, did you guys ever do an analysis of, by stretching out the brackets, creating more standard, bigger standard deduction, offering, exemptions for the, like Medicaid, that I guess the lower income or middle income might be spending more money, have more money to spend, but for the wealthier, they may not necessarily spend the savings. They may save the savings. Did you ever kind of do an analysis what's the net effect of all the, creating the tax relief of all of the stretching out the brackets, increasing the standard deduction?
When we did the macroeconomic impact, we didn't do it by income level. So we kind of looked at, okay, overall, if people get this tax relief, what is the impact on spending overall? But we didn't break it down. So what you're saying is that marginal propensity to consume. So the would be different depending on the income level, and
Yeah.
you would adjust it like that. So we didn't go to
Okay.
that detail.
But
So
you did assume that a certain amount of the savings would be spent,
Correct.
and then we would then see higher GE taxes, yeah,
Correct.
based on that.
I kind of remember, if I remember, Dr. Kobe said that they did a different analysis on the revenue impact, right? It was a dynamic impact versus a static impact.
Right.
Yeah.
So
In other
we
words,
did
it
take that into
considered
account.
the potential
but
future spending
we didn't do it at a
overall basis.
differential effect based on income. We did an overall, the total individuals getting this tax relief. What is the impact on the economy? So we did that. That's what we mean by the dynamic, but we didn't break it down by income groups.
So
yeah, so basically it's a consumption function that's at the aggregate level. So it says if aggregate income for the economy goes up by 5% because of the tax cut, then you don't get a full 5% increase in consumption. Instead, you get, some fraction of that. So the savings is there, and it is, in principle, it's consistent with what would happen if you did it from the very bottom up micro, but it's an aggregate calculation. Because that's just the way the model is set up.
So in other words, the revenue impact was adjusted downwards to consider potential increment, more spending, but by some base of the taxpayer, some percentage of the taxpayers.
So we were talking about possibly raising the forecast, I think, as the out years progressed. And if you look at the current forecast, which is what my motion was to adopt, and the current forecast in table 1, that's a below the line forecast, right? And so fiscal year 27 is 2%. So then if you look at table 5B on page 9, it shows that the current model forecast would give you 2.5% above the line and 1.2% below the line. So I know this is not perfect, but so roughly 1.3% percentage points different. So in other words, in the current forecast, 2% below the line is roughly the equivalent of 3 to 3.3% above the line, which is, when I say above the line, I mean the economy. And when I say below the line, I mean after taking into account the tax rule changes. Does that make any sense at all?
So it is an optimistic forecast.
And then fiscal year 28, the current forecast is 1.9%. And in fiscal 28, in table 5B, the gap between the above and below the line is 1.8 percentage points. So that would mean approximately 3.7% above the line if we were to apply that difference to the 1.9% in table 1. I know this is pretty convoluted.
Wait, you said 1.8, or is it the difference
1.9
between
plus
1.9?
1.8?
Oh, 1.
It's
So basically,
significant.
it would seem that that above the line, I mean, we're looking at least 3% growth on all years.
Yeah,
above the
and
line.
higher in 28 than in 27. So 27 would be 3.3 maybe, and 28 would be 3.7. And the variation there is because of the tax.
Yeah, the projected tax bracket expansion next time around is in 2027 calendar year, and that means mostly affects fiscal 28, and then the next one is calendar 29, and it affects most of fiscal 30. That's why you see a little bit of a dip and then goes up, because last time you gave above the line, and then that's why there are variations. So it's not all 3%, but there's a little bit of dip and then goes back up. So you were right. in the way you described it, Carl.
So, I mean, Mike, I think the forecast is actually pretty optimistic already. I mean, 3.7% in fiscal 28 nominal. So, that's 1.5% real probably. That's pretty good.
Mhm.
I mean, it's not a boom, right? I mean, obviously, if things just take off, that's a different story.
Sounds good to me. I just wanted to hear verification that that was what the case was.
Yeah.
So if you go out to
Good
fiscal
question, Mike.
30, the gap between above and below the line is a full 200 basis points.
Wow.
So that would mean like 3.8% above the line in our.
5.8, yeah.
So we would be basically be going up to 3.7, 3.8 and hovering around that level.
3.8.
Do we have a second?
I second.
Okay.
Oh, wow.
Wow. Any further discussion?
Okay.
No?
Okay, the motion on the table is to keep the council's current forecast for the out years from fiscal year 2027 to 2032. So the estimates below the line would be 2% fiscal 27, 1.9 fiscal 28, 2.5% fiscal 29, 1.8% fiscal 30, 3.1% fiscal 31, and 3.4% fiscal 32. Okay, we'll take a vote. Vice Chair Maynard,
Aye.
Dr. Bonham,
Aye.
Councilmember Hayashi,
Aye.
Councilmember Astegard Clem,
Aye.
Councilmember Hamasu,
Aye.
Councilmember Bennett.
Aye.
Okay, so the vote carries unanimously. Okay, next item on the agenda is what
Kurt,
report by budget. Oh, sorry. Go ahead.
is it okay if I paste the growth rates into the chat for the person who asked what they were going to be?
Sure, sure.
Okay, I just copied them out of the table. So,
Okay. Okay, so the next item coming up will be the budget and finance report, right?
Hi. Aloha. Good afternoon, Chair Kawafuchi and council members. This is Greg
Good
from
afternoon.
Budget and Finance. We have provided you with our report of revised projections of the general fund, non-tax revenues, non-general fund, tax and non-tax revenues since the September 4th meeting. The revenue estimates were prepared by the departments, November, and were based on point-in-time assumptions made by the programs and department staff. So our report of significant changes is included, and I will just highlight some of them. Hold on for a second while I pull up the screen. Are you able to see the screen?
Not yet.
Okay, hold on for a second. Is it up yet by chance?
Yes.
is
just
now.
kidding.
Okay, so the tables I like to highlight are actually table 4A, which is the special fund non-tax revenues. So actually the significant change we had here was a net increase in fiscal years 26 through 32, which reflect projected increases in federal reimbursements for operating and capital grants from the Federal Highway Administration. And they're based on FY25 actual reimbursements. So that would be this line. So they're actually It's actually going up by about 50 million in each of the fiscal years. And the other thing that was kind of significant was the table 5A, our federal grants again. So this was actually the net increase from fiscal years 25 through 29, which are reflecting updates of actual revenues and the revision of projected federal reimbursements based on fiscal year 25 actuals for grants for like temporary assistance and needy families, medical assistant grants. These are at the Benefits, Employment, and Support Services Division, MedQuest Division, and Hawaii Public Housing Authority at DHS. Total changes were about 127 million in fiscal year 25, 1.8 billion in FY26, an additional 732 million in FY27, another 270 million in FY28. And that's about all I have to highlight this quarter.
What is causing that?
So I guess the end of the federal fiscal year is September. So
Yes.
they get, I guess, they update that they received, I guess, for their reimbursements for their federal grants. And using those numbers, they actually go out and project what they think was going to come in for the next fiscal year and perhaps in the out years. And I had asked them, I said, the current federal administration is trying to cut back, but they told me that they haven't indicated that the federal government hasn't indicated any particular grants that they're cutting. So that's why they're keeping their projections kind of what they had annualized previously.
Because the number is huge, right, for fiscal
Yeah.
26.
So that one is mostly medical assistant grants. So
it's 1.8 billion more than the.
so that's a net. So that's like all these different grants going into DHS. It includes TANF funds, TANOF funds, FMAP funds. Those are medical assistant grants.
So we had previously estimated 2.4 billion. Now it's 4.2 billion.
So let's see. So on top, that's table 5A. Yeah.
So it sounds like what you're saying is that they don't have any information to base a projection of how much federal funds are going to go down. So they simply started with the most recent data and projected it out from there. So yeah, they'll be wrong, but they don't have I mean, I understand that you expect those funds are going to go down, but you don't know which funds are going to get cut by how much.
Wow.
But fiscal 25 is an actual number. It went up to 4 billion.
Oh, excuse me?
For fiscal 2025.
Yeah. So those are based on actuals.
A little bit.
Yeah, those are actuals.
Okay.
So whatever had closed in the previous fiscal year is included in there.
But
so
this
Greg,
is our oh, go ahead. Sorry. Go ahead.
In September, the forecast in September was a substantial decline between 25 and 26.
Yes.
It was about $1.5 billion decline. And just the federal line is what I'm looking at. And now that pessimism isn't being held is what I'm hearing.
Yeah, so I guess they had more grants. So they based this on grant awards. So, whatever they received, and then they have like a time period that they can expend the funding in. So they get reimbursed as they spend it. So I think there was actually a push for them to expend more this past year because they knew that some of it might be going away. So that's why they increased their expenditures and thus got reimbursed more, which is actually boosting the number for their projections in these out years now.
Can we get them to spend more faster?
I work for budget and finance, so we're kind of like the opposite of that.
Yeah.
So Greg, these all represent grants that have been awarded, right? So
Yeah,
we
yeah.
we basically, in theory, the amounts, unless something gets cut, the thought is that the money's there for us to spend, right?
Yeah.
Okay.
And sometimes they can't even reach that amount that is in the award amount, but they try their best.
Is there more confidence going forward in 28, 29, and 30? Because it seems like those numbers seem to have stabilized.
I can't talk to what the logic behind that is. Yeah.
Sorry, Greg, and going back to the point you just made with me is, so 4.2 billion, are they thinking they're going to be able to spend that in this current year?
Yeah, so that's based on whatever they had
Okay.
spent in the current the FY25 federal fiscal year.
Wow.
Well, it's great news for assistance programs.
Yeah.
It's wonderful news.
And there was just recently that didn't Hawaii
Yeah.
receive like 160 million, was that right? Or I forgot what the number was, but
Per
it was
year.
per year.
It's
Okay.
it's the rural health. I think
Mhm.
that's probably what you're talking about. The
Yep.
the rural health fund that was set up during the shutdown. No, it was part of the budget reconciliation act, and I'm pretty sure it's 160 million a year for 4 or 5 years, 190 million a year for the next 5 years. Yeah, the state was very successful in that.
And that's all I had to highlight this quarter.
Thank you, Mr. Hirohata Goto. Any questions of Mr. Hirohata Goto?
Thank you.
Thank you.
Thank you.
Okay. Any motion to approve the report by Budget and Finance?
So moved.
I'll second.
Okay, we'll take a vote. Vice Chair, the motion is to approve the report by Budget and Finance. Vice Chair Maynard,
Aye.
Dr. Bonham,
Aye.
Councilmember Hayashi,
Aye.
Councilmember Ostagat Clem,
Aye.
Councilmember Hamasu, and Councilmember Bennett.
Aye.
Okay, so the motion is unanimous. So the Budget and Finances report is approved. Okay, next item on the agenda is the next general fund meeting in March. Babers, when do we have to report? Is it March 15th?
It is March 15, which is a Sunday, so
Okay.
maybe sometime in the week leading up to that. Thursday is the 12th, Tuesday is the 10th, Wednesday is the 11th. Any of those days, we will have the preliminary for February available in any of those days. So
Which
depending
dates are
on
you
your
talking about?
availability. So that week of
March 15th.
March
March
9th.
9th. March 9th.
Yeah, so Tuesday, Wednesday, or Thursday, depending on it. It's a little tight turnaround if you do 12. So ideally, we want it to be a little earlier, but we'll work with.
How is
Tuesday or
March the 10th?
Wednesday works for me at 2 o'clock.
Okay. How is March 10th at 2 o'clock for everyone?
That's a
Christy,
Tuesday.
Christy,
Yeah,
are you
Tuesday,
saying
March-
Wednesdays
Tuesday,
work better
March-
for you?
I'm sorry.
Yeah. Oh, I think Wednesdays work better for me for this
Oh.
semester too, right? Christy, you're saying Wednesdays?
Tuesday or Wednesday work.
Oh,
for
okay.
me.
Yeah,
Thursday is problematic.
okay.
Okay.
I can do either one, but
Are you okay with either one, Regina?
yes, I can do either one.
I'm good with
Any
either.
other?
Greg, you might want to quit sharing your screen
Greg, you gotta.
before you enter your credit card number. So are we Tuesday at, there we go. Tuesday at 2? No, he's back.
Oh, still
Okay.
there.
See if I can get rid of it. Okay. Wednesday or Tuesday?
Regina, is Tuesday okay with you? 2 o'clock?
Yes, I can do
Okay.
either. Yep, 2
Okay.
o'clock at Tuesday, the 10th. Yep.
Next meeting then will be scheduled for Tuesday, March the 10th at 2 p.m.
Right.
Okay. Any other matters before we discuss offline we go offline to discuss the other two matters? Okay. Okay. Thank you, everyone. The Council of Revenues meeting for general fund is concluded. Okay.
Right. We may go offline.
Okay.
Okay.
Okay. So, Babos, can you